So we all realize that we're now in a much more challenging interest rate environment caused by the inflation that has been stoked upon us by all the fiscal stimulus that came out of COVID as a result. And what that's doing is it's spurring a lot of questions and concerns from our clients that utilize our tax strategies, which are a borrowing to invest foundation. And what that does is it creates tax deductible interest that can be used to offset income in different manners. But what's important to understand is that when you're considering a borrowing to invest strategy, it's the after-tax cost of borrowing that is the most significant number, not the gross number. For an example, 7% interest rate, if you're at a higher tax bracket in the 40% range, is going to be 4% net. Now, realize that most of the assets that we would incorporate inside these types of borrowing to invest strategies are going to pay out a return of capital distribution that is far greater than the 4%. So you're good. You're net on an income or distribution basis to cover that cost of borrowing without any additional upside that the market may bring throughout a recovery. And that's what's crucial. And if you also understand that most of these strategies, if not all of them, are going to be longer in duration. You're not going to set up a tax deductible mortgage strategy for 2 to 3 years. It's going to be to knock off several years off of your mortgage and become mortgage free much quicker. An RSP meltdown strategy is not a short-term window. You're going to do this through the entirety of your retirement income years so that you can create more tax efficiency. So what that means, you're more susceptible to the average interest rate over, say, a 10 to 20 year period than you are in the short term. And if you look at rates over that period of time, they're going to be stabilized and they're going to be below the economic value that you can receive by investing in different asset classes. That's just sheer economics. But what's crucial in this period where things get a little bit rocky and we see those increasing rates is it's the after-tax cost of borrowing, which we are still beating handily. And the reality is, until you get to 9 or 10% interest rates, which means your after-tax cost of borrowing is in that 6 to 6.5% range, well, then that's where you start to give consideration whether the strategy is suitable or not. But we are a long ways away from that, and the economy is already starting to roll over, which means that the interest rate increases that we've seen have done its job. It's going to help push us out of this inflationary pressure, but that also means that we're heading likely to a more stabilized or deflationary part of the business cycle where rates can actually come down in value and provide that much more prosperity within these strategies. So again, focus on the after-tax cost of borrowing. If you have any questions about what that means or what that math looks like, reach out to us. We're happy to walk through the exact illustration. But for the most part, you have to take the cost of your borrowing minus your tax bracket, and that's your net cost, which we are easily beating and will consistently do for a number of years.